Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about stocks you could buy and forget about and sleep well at night, right? There's some stocks where you could buy and try to forget about, but they'll always be in the back of your mind, and you check it um, when the market's closed or when the market opens just to check on the price, right? That happens to everyone. But these stocks you could really buy, forget about for a couple years, wait till all this madness passes us and check your price, and you'll be happily surprised. That's what we're aiming for. So not the totally riskiest stuff, but also not the safest, because we're looking for some appreciation. So right off the bat, I'm looking at this screener here. This is FinViz. I'm choosing the criteria EPS growth past 5 years as positive. Same with the next 5 years. We're looking at a new 52-week low and oversold under 40 RSI. So we're going to start right with 3M. Of course, I'll show you why. So 3M is one of those companies where you can buy and forget because of that nice juicy dividend yield. We checked the weekly chart just to go back to COVID times, and you can see we're right around that price. COVID low of $115. We are at $134 right now. Not a bad bet, especially with that cheap forward PE and PE ratio. However, the growth is kind of slow. You can see EPS growth next year 5%. Next 5 years, the annual growth estimate 6.5%. Past 5 years 4.4%. So it's a slow grower, but you're given that dividend yield each year, as well as that solid steady growth. Now with 3M, you can see the top was $206. Right now we're $135. We need a 50% increase from this price to get back to all-time highs. I'm sorry, to get back to this high of $200. Previously, we could check 3 months, and 3M was once worth almost $250. So right now, 200 is not the most conservative estimate, because of course it is still a 50% increase. But you could see that 3M belongs in the 180s, 170s at least. And right now at the 135, it's kind of a no-brainer. You could buy a couple of shares, park them in your retirement account or what have you, and essentially forget about them. And then we'll go back. There's another one on this list that we can entertain, and that is on page 2. I like to look at Stanley Black & Decker. This is a tool company, has the yellow and black tools, power tools. And with the slowing economy, whatever we're going into, sure, homes will not be built as much, but you can sure bet that homes will still be improved upon, because as mortgage rates are growing, it makes sense to invest in these home power tools to get the job done and to keep your home sustainable for your family, for yourself, to keep it in good condition, to where you can sell it for a profit, even if the mortgage rates are 7-8% in the next couple months. So Stanley Black & Decker, we have a 3% dividend yield, a very, very low 4 PE ratio, and a conservative valuation here, a PEG of 1.04, with double-digit growth estimates as well as past growth. The only problem with this one is not very much cash, as you can see, 104 price to cash, and per share, of course, and then the current ratios are also under 1, and you're trying to aim for at least 1. But with that price reduction, we're looking at a double from here, so we'd have to go up 100% to get back to the previous highs, which is double 3M. And now we're going to look at another screen here. Instead of new low, we're going to go any and under the SMA 200. Now this is going to bring a lot more stocks out. So look at the results right here, 753. We'll look at, try to get less than that, 122. All right, we definitely did that. So it's obvious right here, but Walmart, I think, is a really good bet at these prices. for a good reason, because we are getting them at pre-COVID prices. As you can see here, 120, and the year is 2019. We are getting that same price 2.5 years later. And you can see PEG is high, of course, with the high valuation, the high PE ratios, and the low growth estimates, because it is the largest sales company in the world. It generates the most revenue, $500 billion a year, $500 billion. Now, out of that, of course, the income is very, very slim because it has a lot of overhead. You're talking the stores, you're talking distribution, you're talking the employees, but it also has a 2% dividend yield. But we are seeing it at a quarter. We're getting it a quarter cheaper than what it originally was. So with that 25% discount, once this loads, we're getting at 120. Price could go back to 160. You're looking at a $40 a share increase, which is essentially a 30% increase. That's what we're looking at here. 120 to 160 is a 30% increase. And who knows if it goes back to 160. It looks like it belongs to the 140s, 130s, and that's still up from this price, even though not by much. It's kind of an obvious bet, Walmart, because you can't imagine Walmart to go away when groceries are not being delivered same day or same hour, when you could just go to Walmart, get the groceries, or having to wait 2 days with Amazon. Amazon has yet to master the grocery game. So that's why Walmart is still living up to the promise of fast, affordable food and goods of what you need in your everyday life. Besides that, guys, that's the most obvious stocks I see. You could go a little risky with Procter & Gamble because it is up quite a bit from that COVID low. Same with Sherwin-Williams. Same with SPG. I know Chris is buying SPG now. You could either buy it now and hope for the increase here soon, but just know that it is still up double from that COVID low, and it's hard to buy stuff, in my opinion, although it was entirely different circumstance back then compared to now. We're talking inflation, we're talking economic hard times. Back then, we're talking complete shutdown of any retail physical store. So that's the obvious ones, guys. We're looking at 3M, Stanley Black & Decker, and Walmart. Let me know if you have any other obvious choices that you'd recommend to other investors to sleep well at night. I'd love to hear what you have to say. Thanks for watching.